Thank you very much. Welcome, everyone. We're very glad you could join us today for this Thought Center webcast. My name is Alex Posma. I'm EY's Global Director of International Tax, and I'll be your moderator today. Today is the second in a series of 4 Global Thought Center webcasts titled Advancing in a Global Tax Environment in Flux. This second webcast focuses on the critical topic of international tax controversy. But before turning to our topic, we, of course, have a little housekeeping to take care of. As usual, we will take questions throughout today's session. Using the red Q&A icon at the bottom of this interface, you'll have the ability on your desktop to send your comments and questions to us, and we'll try to get to as many of those questions as we can during our limited time today. Second, there will be polling questions that appear throughout this webcast, and you need to respond to them in order to qualify for your CPE or CE credits. So, if education credits are important to you, please keep an eye on your screen for these polls during the course of this webcast. Now, we're not likely to have time to comment on all of the outcomes of the polling questions during the webcast, but the results will be shown on screen. Finally, if you like today's slides, then you can download them by clicking on the green folder icon at the bottom of this interface. Now, with that out of the way, let me introduce our terrific global panel for today's discussion. Joining me are Matt Mealy, our International Tax Services Leader for EMEA. Matt has over 20 years' experience advising clients on international tax matters. His clients include both in- and outbound companies across all types of industries, but predominantly in the FTSE 100, Fortune 500. Welcome, Matt. Next is Mike McDonald, who has recently transferred from the U.S. Treasury to join our National Tax Office in Washington as the Transfer Pricing Policy Leader for the Americas. Mike rejoins EY from the U.S. Department of Treasury, Office of Tax Analysis, where he was a financial economist in the Business and International Tax Division since 2001. Welcome aboard, Mike.
Thank you, Alex.
And then we have Catherine Pinzon, our Transfer Pricing Leader from Brazil. Catherine has vast experience in Latin America and the United States, as she was the Florida Market Transfer Pricing Leader from 2012 to 2014, but also was EY's South America Transfer Pricing Leader from 2009 to 2012. Welcome, Catherine. Finally, Luis Coronado, our ASEAN Leader for International Tax Services based in Singapore. Luis has worked in Asia since 2005 as part of his more than 20 years advisory experience in international tax and transfer pricing issues. And I'm very happy to have you on board for this webcast, Luis. That leads us to our topic of today. I think it's safe to say that the international tax environment has been experiencing some revolutionary changes in the last couple of years. And the question in front of us today is what impact this has on the amount of controversy companies will have to deal with. Our agenda for today, therefore, looks like this. After a brief overview of the reasons for the rising surge in cross-border controversy and the likely approach of tax administrations in conducting their audits, we'll move on to consider how to identify potential controversy trigger points in your organization. We will subsequently discuss the controversy process and remediation strategies, both reactive and proactive, open to companies, and we'll wrap up with looking at some of the potentially unexpected consequences that may be easily overlooked. But before we get into any of this, let's have a polling question to see what you think of this. And we've asked many times in the past about the overall level of tax disputes and controversy, and it's been pretty clear every single time that all of us expect more controversy in the future. So let's look instead at the potential timing. The results will appear in your screen as soon as we've collated them. And meanwhile, Mike, can you already give us a brief update on the global trends affecting the tax landscape and your view on the impact this is having on tax controversy, perhaps focusing most strongly on your own specialization in transfer pricing?
Thanks, Alex. I think it's hard to argue against the fact that the BEPS action items have significantly transformed the international tax landscape. I think the combination of and the interaction between a number of trends in particular will drive the dispute landscape in the coming years. These in no specific orders are the modification and clarification of transfer pricing rules under Actions 8 through 10, the combined country-by-country reporting and transfer pricing reporting requirements under Action 13, similar transparency and disclosure requirements under Action 12, which is our last webcast on transparency showed, are now being translated into national level programs all around the world. The use of the new multilateral instrument, or the MLI, to quickly incorporate important BEPS minimum standards into the treaty networks, and in particular the mandatory adoption of the principal purpose test, PPT, by countries under BEPS Action 6. Also, enhanced information sharing among tax authorities, not only in terms of formal processes like the country-by-country reporting, but more informally with groupings like the Joint International Task Force on Shared Intelligence and Collaboration, and which are now sharing far more important information among themselves on new business models and structures. Now, taken together, I think these developments have significantly tightened the rules and also enhanced the tools available to revenue authorities to question, to assess, ultimately to adjust taxpayers' positions. In addition, the increased subjectivity of the rules under many of the BEPS actions will only increase the likelihood of double taxation, and so disputes between tax authorities will increase, with taxpayers stuck in the middle. So while the combination of the action items may not be a perfect storm for taxpayers, it'll undoubtedly be hard slogging, especially in the near term.
So you're sounding like spring tide rather than tsunami. So I'd like to get an answer on that. Is it which one is it? And can you please provide a little bit more detail on a few of the key BEPS specific drivers like Action 8 and 10 and 13, and perhaps a couple more words on the MLI?
Okay, very good. Well, let's start with transfer pricing. Under BEPS 8 through 10 and 13, the BEPS project has made really significant modifications to the OECD transfer pricing guidelines, in particular with respect to risk and intangibles. And importantly, these modifications apply immediately and potentially retrospectively because the modifications are viewed as a clarification to existing principles that were already there under Article 9. And so I say retrospectively because depending on the law and approaches of particular jurisdictions, the modifications might be applied not only to new transfer pricing cases, but also to open tax years. Now, I want to talk a little about risk and intangibles. With respect to risk, the OECD guidance provides a process-based approach for analyzing the taxpayer's allocation of risk and determines that such an allocation may be recast by the tax authority if the entity that is contractually assuming risk is not able to control the risk, which is a defined term, and doesn't have the financial capacity to assume the risk. Now, this can actually have a profound effect on taxpayers, as risk is simply fundamental to determining the intercompany transactions themselves. In addition, the guidance on risk is unfortunately somewhat subjective, and it's therefore susceptible to different interpretations. So the combination of guidance that is both fundamental and subjective is a recipe for significant disputes. Second item, intangibles. The guidance, while clearly recognizing legal ownership, it clarifies that such ownership doesn't necessarily generate a right to any or indeed all of the return associated with the intangible. The group companies performing important functions, and so you'll hear the term DEMPI, which simply stands for particular functions: development, enhancement, maintenance, protection, and exploitation. These are functions or activities that are particularly associated with intangibles. So the group companies performing those functions, controlling economically significant risks, and contributing assets must be appropriately remunerated. In addition, there's new special guidance on hard-to-value intangibles, which allows tax authorities in particular situations to use actual outcomes to reprice prior intangible transactions. Can we go back to the previous slide, please? The new guidance is supplemented by increased reporting requirements and, importantly, by enhanced sharing of information between tax authorities. Transfer pricing documentation requirements have been significantly modified by the introduction of a master file and local file requirements, and by the imposition, as I said before, of country-by-country reporting of key information such as sales, profits, assets, headcounts in every jurisdiction in which the multinational operates. And a lot of this information will be shared with all tax jurisdictions in which the MNC operates, as will information on unilateral APAs and tax ruling. Then, Alex, you asked about the MLI. So with respect to that, the multilateral instrument, MLI, to modify bilateral tax treaties provides the means to very swiftly modify treaties to help implement some of the BEPS minimum standards and institute other measures. Now, the BEPS minimum standards are a review of preferential tax regimes, establishing a transparency framework for tax rulings, the implementation of the CBC reporting, and making dispute resolutions more effective. But the treaty measures included in the MLI also include those related to hybrid mismatch arrangements, which were discussed in Action Item 2, treaty abuse, which was a topic of Action Item 6, PEs or permanent establishments, Action Item 7, and mutual agreement procedure under Action Item 14. Now, these treaty measures enhance the ability of countries to deny deductions and or to force income inclusions, to expand source country taxing rights, and introduce potentially subjective treaty shopping provisions. But on the other hand, the minimum standards on MAP is intended to facilitate countries providing access to MAP and using best practice approaches in order to eliminate or at least mitigate double taxation. And among the alternatives available through the MLI is binding arbitration. So, taken together, the BEPS-related measures are likely to initially raise a number of queries from tax authorities because they'll want to understand and connect the various new sources of information. Subsequently, it will increase audit assessments and MAP disputes for two reasons. First, I think we'll see a greater assertion of taxing rights associated with each country's interpretation of the BEPS guidance. And second, there'll likely be more disagreements among countries associated with the inevitable differing interpretation of the BEPS guidance. But it's not the only area of change. There are a number of initiatives outside but related to the BEPS work that'll have really important ramifications for multinationals. A number of countries have introduced what can generally be called diverted profit tax measures, which imposes levies on company profits that are routed via what they see as contrived arrangements to tax havens. Another of the pretty far-reaching initiatives is the European Union's ATAD, Anti-Tax Avoidance Directive, which seeks to implement a number of the minimum standards on anti-tax avoidance across and also connected to the EU. Now, the ATAD measures are intended to go into effect pretty soon in 2019 and 2020, with the latter date focusing on hybrid mismatches with non-EU countries. So, in answer to your springtide, like which analogy holds, Alex, I think we're definitely looking to significant disruptions to international tax norms, and with it ensuing controversy. In fact, it's not just us who are forecasting the upheaval. Pascal Saint-Amand of the OECD, he's recently made remarks stating that tax audits probably have and will increase. He said that they don't have data, but they believe that there has been such an increase. Further, he said, the BEPS project has brought some new provisions which could be considered as too subjective. And he said it's not completely untrue. So unpacking that, I think that means it's at least partially true. So all in all, I think there is a current storm, but perhaps more importantly, the risk of a tsunami of disputes in the future.
Mike, thanks for setting that background. Now let's turn our attention to how tax authorities in various jurisdictions are preparing for these developments and for the enhanced flow of information. And in particular, what is a typical audit process look like going forward? And will there be differences between regional or country approaches? Matt, perhaps you'd like to start.
Yeah, thanks, Alex. And maybe I'll pick up on yours and Mike's storm analogy. So I think there's going to be the flood of information, and that's particularly under BEPS Action 13, that's going to need to be absorbed by the tax administrations. And you predict that will raise a number of additional questions. A very recent survey that EY did showed a current significant increase in questions in 90% of the countries interviewed. So 2018 will be the first time that tax authorities around the world receive the enhanced global information on large multinational groups with operations in their country. As we all know, the BEPS Action 13 data breaks down a group's worldwide revenue, profits, tax, and other attributes by jurisdiction. In addition, it will provide information on legal and financial structures and on supply chain and IP. In that regard, the information represents a significant opportunity for tax authorities to understand the operation of a group's business in a way that simply was not possible before. And we're seeing tax authorities beginning to get organized around how they're going to respond to that. For example, a couple of weeks ago, the OECD issued a new report titled the CBCR Handbook on Effective Tax Risk Assessment, setting out how tax authorities may use Action 13 information to supplement their existing tax risk assessment protocols. Chapter 4 of that handbook is of particular interest to taxpayers, as it considers not only the ways in which CBC reports can be incorporated into a tax authority's risk assessment framework, but also describes many of the main potential tax risk indicators that tax authorities will likely run across the data they receive. The report goes on to set out a series of 19 specific risk indicators that can assist an administration in detecting recurring transactions and one-off transactions that should potentially be subject to future scrutiny. For each risk indicator, a summary overview is provided, and an annex sets out what potential results could mean, and also explores other potential circumstances that could explain the results. It should be expected that national tax administrations will, at a minimum, utilize the risk indicator tests as outlined in the report, and the report therefore includes useful data for those companies wishing to develop pre-submission testing to ensure their own compliance risk assurance processes and approaches are aligned with those likely to be adopted by the national tax authorities. Additionally, the country risk assessment protocols provided for 7 key countries provide really useful insights for M&Es currently operating within those jurisdictions.
Hey, Matt, looking at the indicators in the CBCR handbook, there are clearly some expected ratios, right? Effective tax rate, profit margins, profit per employee, separation of IP in separate entities, percentage of related party revenue. So also, as expected, there's kind of a focus on mobile activities based in low-tax jurisdictions. And on the change or the location of valuable assets such as IP. However, I was a bit surprised to see procurement activity indicators stand out. And I have to say I was very surprised actually by the deviation of market trends indicator. Also, there seems to be a very strong focus on so-called jurisdictions of interest, to me, which seems a euphemism for alleged tax havens. And they do that, the handbook does that, in effect, without regard to any level of substance in those jurisdictions, which I would have thought to be essential in the light of Action 5, where it's clear that a low tax rate by itself is acceptable.
Yeah, you're right to pick that out, I think, Alex, because I think it is clear that low rate of tax itself is not a harmful tax practice in the context of Action 5. I guess the point is that a low rate of tax might be a risk indicator for transfer pricing purposes, because at least it might provide an economic incentive for erring at one end of the arm's length range, let's say. But whichever way round, it's definite that there's a clear focus on stateless income, on low tax income, and that's also apparent from best practice guidelines around BEPS measures that the OECD and the Forum on Tax Administrations are developing. Part of that is obviously because in cases with stateless or zero taxed income, there's usually no applicable tax treaty and no possibility of MAP, and that means that countries can win $1 of tax without any consequential bilateral discussion or negotiation. So they get a much greater yield for their administrative efforts than if they have to win $1 of tax from another country who has to lose. It's probably illuminating to examine how the practice guidelines translate across to the actual on-the-ground experience of taxpayers going through audit inquiries. There's clear evidence to suggest the BEPS initiative and the enhanced exchange of information between tax authorities has already encouraged some tax authorities to adopt much more aggressive inquiry techniques. At a high level, we're seeing consistent global trends in tax administration, and I think these include much greater demands for information, much less trust in information provided by taxpayers without subsequent audit and validation, and much greater sense of entitlement from tax administrations to non-territorial information and broader business background to assess business purposes. These administrative changes are being applied to transactions implemented 5 or more years ago, which are under audit now. As such, the effective impact of more assertive administration is retrospective, just like Mike said earlier in terms of the retrospective interpretation of BEPS 8 to 10. And also we're seeing a move away from a sovereign approach to an increased interest in what is happening in the other jurisdictions where the MNC is active. And that's manifesting, for instance, as a reduced reliance on one-sided transfer pricing analyses and a corresponding demand for multi-sided analyses. Of course, a multi-sided analysis was always necessary under the OECD guidelines, but the reality is that very many countries accepted or even encouraged a one-sided approach because it was simpler and it was accepted as a more efficient proxy.
So let me interrupt you there for a second. Can you explain a little bit more clear what you mean by multi-sided TP analysis? Because I think a lot of people are not used to that. And in your analysis, what, if any, is there a possible impact of the U.S. tax reform on all of this?
Sure, Alex. So put simply, in the past, many tax authorities reviewed the functional profile only in their own country in order to assess an appropriate arm's length return on those activities. And you can see that that's an efficient approach. Very many unilateral APAs and controversy settlements were agreed using that approach. Increasingly, however, tax authorities are insisting on a full disclosure of the position of all parties to a transaction or series of transactions, a multi-sided analysis. That's in order to obtain a better and fuller understanding of all aspects of a group's operations, the better to evaluate the role and contribution of the entities in their own jurisdiction. And as a result, groups are being required to prepare two-sided or multi-sided transfer pricing analyses to support their pricing policies. That's also part of the reason why fewer jurisdictions are now prepared to negotiate unilateral APAs, and why we're seeing more bilateral and multilateral APAs. And I think it's also confirmed by tax authorities increasingly looking at multi-jurisdictional audit or simultaneous audits. One of the most worrying trends that comes from that is the increasing incidence of penalties where transfer pricing positions were based on a one-sided analysis, even though countries were themselves complicit in promoting or using one-sided analyses as a more efficient shortcut to the estimation of arm's length prices. And then, Alex, to your point on US reform, I can certainly see some US-based MNCs reshoring intangibles to the US under an optimistic version of potential US reform. And if that happened, it could indeed reduce current pressure points related to certain amounts of stateless income and focus on entities with limited substance or limited control over risk and business processes, as Mike mentioned earlier.
Thanks, Matt, for that overview. So now let's see what our listeners' appetite for disclosing more information is. With another polling question, Catherine, what about the Brazilian authorities? Are they applying similar tactics, and how about the rest of Latin and South America?
Sure. For the Latin region, BEPS is indeed used by tax authorities to bring support to and raise the bar on already quite assertive position on transfer pricing audit. All tax authorities within the region, excluding Brazil, have been focusing on requesting massive amount of documentation about related and non-related parties in other jurisdictions, already including even final third-party customer information. So the data provided in Action 13 will increase the appetite for information. For many of these authorities, it was also not clear how to determine the value creation in a supply chain. So BEPS, Actions 8 to 10, gives these tax authorities more technical guidance on what to ask and how to support their arguments in their audit processes and assessment in the aspects that were below the radar before BEPS. So regarding Brazil, it is not clear how the Receita Federal will approach the additional information that it's receiving from CBCR, since there is no direct connection with the local transfer pricing rules. The Receita Federal representatives have nevertheless been very participative in all BEPS discussions, and it seems that Brazil's position on this matter will continue to be active. I believe that Brazil will have a very interesting development in this area in the future years. So let's wait and see how the uncertainty evolves.
Okay, sir. Thank you very much, Catherine. So, Mike, what is the IRS doing with audit procedures in the light of BEPS?
Well, I think like other jurisdictions, the U.S. will benefit from additional information that it'll receive as part of the BEPS initiatives with respect to transparency, such as the CBC information under Action Item 13. And so this will help in their risk assessment in their examinations. But I don't think the additional information is going to be as incrementally helpful as it might be for other jurisdictions, because the IRS already collects an awful lot of information as it is. Like when you think of the 5471, the 5472, the transfer pricing documentation. But with respect to the impact of the BEPS guidance itself on IRS audits, well, the U.S. will continue to apply the transfer pricing regulation, Section 482, to cases in audit that it expects to proceed to IRS appeals and to litigation, since 482 are the applicable authority in U.S. courts. But of course, the OECD guidelines are relevant for MAP cases. But even here, the U.S. doesn't really see a lot of daylight between the OECD transfer pricing guidelines and the 482 regulations. And that really may be indicative that the IRS is likely to view the modifications to the OECD guidelines as not really reflecting a sea change. Historically, the U.S. has tended to respect contractual allocations of risk and tends to concentrate more on the pricing of the arrangements in order to address BEPS concern. But having said all that, I think it's clear that there will be more disputes in MAP with other jurisdictions, given the potential interpretive differences of the BEPS guidance that we talked about earlier. And I think that ties into Matt's discussion of the use of multi-sided analyses. In practice, there'll be greater critical scrutiny of one-sided methods under the most appropriate method standard right now, such as the TNMM under the OECD transfer pricing guidelines, the CPM under the 482 regulations, which traditionally has been the most common method used by the IRS.
I was going to just jump in there. I was just going to add a point here on tax administration developments, which is the increased technological investment and capabilities of tax authorities around the world. So we're seeing various governments on all continents, Russia's been a leader here, Australia, Brazil, investing heavily in data analytics capabilities, not just on the data they're getting from taxpayers or other tax authorities, but also applying resources to other streams of data, such as social media. A survey we did last week among 30-plus countries showed that at least 75% of the jurisdictions are investing in additional data technology for audit. We've seen examples of tax authorities doing reviews of corporate websites, social and public media output, and for instance, we've seen tax authorities interrogate the social media of employees to get a deeper understanding of the in-jurisdiction functionality of a company. Sorry, Alex, for that interruption. I thought it was important to mention.
No, I think that's great, and I agree with you. In fact, a few cases we've seen that the combination of enhanced exchange of information between tax authorities and their data analytics capabilities actually already outpaced a company's own internal and somewhat siloed data provision, which was leading to some, as you can imagine, some awkward discussions. And tax authorities are likely to get better at this. So, continuing, having examined the new audit environment and how tax authorities have been and are empowered to take a more coordinated multi-country approach, we should look at what this means in practice for multinational companies. In particular, let's consider some of the common trigger points. Let's discuss what companies need to do to become aware of the potential risks in their organization. But before we do that, another polling question. Let's see what our audience thinks are the key technical issues that are likely to attract scrutiny around the world. And if your favorite controversy trigger point is not on this slide, then please provide it to us through the Q&A submission. And while we wait for the response, Catherine, can I ask of you to start this discussion, please? What are the most relevant triggers in Latin America?
Thank you, Alex. I would say in Latin America, tax authorities have a lot of focus on the transfer pricing of tangible goods and intragroup services, especially limited risk distribution entities, the classical example being a limited distributor with limited market and price risk. For example, we have countries like Argentina, Ecuador, and Bolivia questioning the substance of triangulation transactions where the foreign principal entity buys final products from a related party contract manufacturer located in the Latin region and then sell it to a related limited distributor located in the Latin region as well. Some of these audits has made adjustment on transfer pricing between the principal and the limited risk distributor, and in some cases even a denial of the existence of such principal entity within that supply chain. On the other hand, we have Colombia, Chile, and Peru. They are focused their transfer pricing audits on commodity transactions and the reasonability of procurement and traded residual profit charges. Moreover, countries like Mexico, Venezuela, and Colombia are denying the deductibility of intercompany services charges, mostly due to the lack of documentation support and inability to prove the benefit test from the taxpayer. It is very common to hear from clients that they are paying a charge for a service that is only described in an invoice. Another aspect that receives keen attention from the tax authorities is the duplication of functions between the service provider and the recipient of the service. Within actions 8 to 10, these situations will trigger assessments that might end up with a denial of the deduction of the charge and possible penalties. And controversy triggers are not limited necessarily to transactions happening within Latin America. Action 13 will provide Latin tax authorities with a global view of activities of their multinationals, potentially raising controlled foreign company exposures on intercompany transactions that were not subject to alternative transfer pricing analysis methodology or valuation locally.
So Matt, thank you, Catherine. Matt, how about Europe? What are in your view some of the main trigger points?
Yeah, so I might choose two top points. One of those would be the transfer pricing changes under BEPS Actions 8 through 10 that Mike referred to earlier, and that have definitely had a significant impact across many countries in EMEA in terms of how they're approaching transfer pricing cases. That's really cases where a disproportionate amount of profit is linked to contractual allocation of risk or legal ownership of asset. I mentioned already the focus of Europe on stateless income and income in low substance entities, not just in transfer pricing by the tax authorities, but also as a key feature in the state aid cases being pursued by the European Commission. And the second top area I'll pick out is permanent establishment risk. So in France, this is increasingly audited by the tax raid. In Italy, there's a sort of amnesty from criminal sanctions where taxpayers accept PEs. The UK and Australia have chosen a different approach based around their diverted profits taxes, and we now have significant experience on audit inquiries around the diverted profits tax. In summary, we're finding that common features are that DPT inquiries are very time intensive. They focus mainly on a functional and factual profile analysis and are typically integrated across different areas, so they cover transfer pricing, permanent establishment, as well as the diverted profits tax. Very standard information requests include a multi-sided value chain inquiry, I mentioned it earlier, a review of source documentation like key contracts, a review of underlying evidence like emails and other relevant documentation, going to that point about trust in taxpayer representations, and then functional interviews with key people, as well as sometimes third-party information inquiries. As a result, these kind of inquiries are really complex. They involve the provision of a very high volume of information, much of it extraterritorial, and the importance of timely engagement with the tax authorities and the provision of relevant and appropriate information can't be underestimated. They're really critical elements in the strategy for avoiding the issuance of a charging notice. The permanent establishment theme will, of course, only expand with the adoption of the multilateral instrument and the lowering of PE thresholds where that's a relevant choice in the MLI. A serious point of attention here are business travelers. With the increased likelihood of PEs, they can easily get trapped into the tax net of the country of the PE if the cost of their remuneration under the source country rules should be attributed to the newly arising PE. And we're devoting our next webcast on 9 November to the topic of Are You Crossing the PE Threshold? So please do join us then for a more in-depth discussion of PE issues, including recent developments on digital PE.
I think clients are likely to be both crashing and crossing the PE threshold, Matt, so both are good. Louis, what's your analysis here?
Well, Alex, aligned with Catherine's comments on Latin America, there is a prevalence, particularly in Southeast Asia, for high scrutiny on service charges and governments limiting or denying deductions with arguments around duplication and or lack of benefit value to the payer. Another point is that despite the OECD's recent analysis and renewed commentary on beneficial ownership, we're still seeing challenges on beneficial ownership in the Asia-Pacific region. And this will only increase with the inclusion of the PPP in the new MLI. It will be particularly relevant for interest and royalty streams. In addition, certain countries in Asia might have remittance issues due to foreign exchange restrictions, as well as giving up on withholding applied to non-arm's length amounts on non-tangible good transactions. Then, in line with Matt's observations, I would say that Asia-Pacific is waking up to PE scrutiny as well. As you already indicated, Matt, in Australia, sophisticated anti-avoidance regimes, including diverted profits tax and multinational anti-avoidance law, MAO, have been introduced. Japan has seen Action 7 type interpretations ahead of actual MLI adoption. These are two salient examples. However, other jurisdictions are starting to be interested in more rigorous review of the potential PE situations.
Thank you, Louis. Mike, the other three panel members have already mentioned Action 8 to 10 several times, and a main component of Action 8 to 10, and perhaps one of the key components of BEPS overall, is IP. What would you say are the main trigger points around IP?
Sure, Alex. As I stated earlier, the BEPS project did make significant changes to the OECD transfer pricing guidelines, in particular with respect to risk and intangibles. And so the IP discussion is really related to the discussion of risk. So can we go back to that earlier slide on the actions? So While the guidance is officially considered to be a clarification to the prior guidance, and as I said, therefore potentially applicable retrospectively, in practice, I think there's no denying that the application of the new guidance is resulting in more challenges to traditional transfer pricing transaction and even affecting the underlying structures. And I think it's most readily apparent with respect to the new guidance on risk and intangibles. Risk. Really one of the most fundamental aspects of intercompany transactions and also structures is the allocation of risk. To take an example, under the arm's length principle, it's perfectly acceptable to separate the assumption of risk from the performance of activities that affect the risk. So, one entity might commit its capital to funding and taking the risks with respect to the success or the failure of a speculative R&D endeavor, while another entity engages in the actual on-the-ground R&D activities, but without taking on the risk through, for example, a contractual R&D services arrangement. Now, such arrangements must have substance, and the entity that's assuming the risk should have the ability to take on, that is, control the risk, and the remuneration to the R&D activity must reflect the full value of the contribution, taking into account, for example, the realistic alternatives, which in particular facts and circumstances might make up the majority of the anticipated profits. Now, these principles have been a part of the OECD transfer pricing guidelines for decades. And it's similarly reflected in the domestic law of most OECD members. Now, the new transfer pricing guidance provides a much closer look at the relationship between risk, and in particular control over risk, and the activities related to risk. The prior guidance devoted only a couple of paragraphs to risk. The revised guidance dedicates over 50 paragraphs to the topic. And I think that has led to greater scrutiny between the decisions to take on and contractually assume the risk and the performance of the on-the-ground, risk mitigating activities such as the R&D. And getting back to your question, Alex, I think this is most pronounced when it comes to intellectual property, where the on-the-ground activities relate to often quite important, I used the term before, DEMPI functions: development, enhancement, maintenance, protection, and exploitation of intangibles. And, in effect, there's greater scrutiny of the technical capability of an entity to be able to contractually assume risk. Now, I think in practice, when there are transactions between two substantive, functionally rich entities, the enhanced scrutiny may not result in increased challenges by the tax authorities. For example, the key distinction between controlling the risk and performing risk mitigating activities is kind of mooted when both entities have the ability to do both. But where there's an imposition of an intermediary between substantive entities, such as an entity with lower functionality that legally acquires or funds through, for example, a cost-sharing arrangement, and it legally owns the IP, then the ability of such entities to meet that technical control requirement it's just more readily challenged. And so taxpayer structures that involve such intermediaries really reflect one of the first key trigger points. A second, though, relates to the fact that the guidance can be subjectively interpreted. I think it's clear that different countries are interpreting the guidance differently. Some are more likely to accept a taxpayer's allocation of risk and then just concentrate on the pricing, but other authorities are more likely to recast or recharacterize the taxpayer's transaction. And so that's a really fundamental trigger point. And the stakes are higher. Challenging and recasting allocations of risk, it affects more than just transfer pricing adjustments that we're used to seeing. Really, they may effectively result in disregarding the nature of the transaction themselves or even the multinational's tax structure. So it really begs the question as where this occurs, what is exactly the counterfactual alternative structure? What is it supposed to be? Because since there's many ways in which unrelated parties can structure transactions, I think there's similarly many different alternative transactions or structures that a tax authority could speculate, and I think speculate is the right word, as to what reflects the, quote, accurate delineation of the transaction. And when you think about the fact that there's at least two and often several different authorities involved in these disputes, you can get just as many different, alternative transactions or structures that need to be priced, with little objective evidence to either confirm or restrain the speculation. So that's another trigger point, which is the potential chaos and controversy around recasting the taxpayer's structure. And there's a related aspect to that, so call that the fourth trigger point, and it's the effect of time. One of the important points raised in the new guidance, which I think is kind of easily overlooked, is that contractual allocations of risk often reflect the only evidence of commitments to bear risk prior to the risk actually materializing. In those circumstances, taxpayer contractual arrangements, it reflects a clear placing of the bets with respect to risk, which imply, assuming that they're substantive, a consistency in behavior regardless of how the risks play out. But if you think about it, audits, on the other hand, typically occur after the risks have played out. The intangible turns out to be a blockbuster, or the research fails and the commitment of funding supporting the research is simply lost. And if you think about the positions of the tax authorities will naturally reflect how risks actually play out, what we might call an outcome bias. So a tax authority in practice might only challenge a taxpayer's arrangement if the risks play out a certain way. And similarly, one or more tax authorities might be in a position to challenge the taxpayer's arrangement no matter how the risks play out. And so I think controversy in practice, hopefully just in the short run, is going to be further augmented by this interpretive hindsight.
So you're caught by one authority if it turns well, and by the other authority if it turns sour. Thanks very much, Mike, for that insightful analysis. And can I sort of summarize that the key trigger points for potential scrutiny are situations where the risk and control over that risk are in separate hands, and that connected there to a divergence between the profit potential and the functionality of an entity might be considered suspect, and that the complexity of these trigger points might be exacerbated by either the size of the transaction and, to your last point, the number of tax authorities that could have an interest in these transactions.
Well, yeah, sure, if you want to capture it in one sentence as opposed to the 10,000 words that I just gave. But yeah, no, I actually think that does capture it. There's an additional trigger that we haven't talked about yet, and that is remuneration on financial transaction. Although financial instruments, although we see a slowly increasing attention by tax authorities around the world, I would assume there will be a significant step up in attention upon the implementation of the tax avoidance directives in the EU, and potentially as a result of U.S. tax reform proposals on financing in the U.S. Moreover, the expectation is that I think in 2018 we're going to see the transfer pricing guidelines on financial transaction, which in my view could mark a significant change in audit behavior by tax authorities around the world.
Thanks, Mike. After this discussion on trigger points from the different continents, let's see what our audience thinks of the level of disputes that we're likely to see over the next 12 months, and whether you listeners actually think there is a tsunami coming. And And now that we have identified a number of common trigger points, I think it's critical that companies understand how the controversy process is likely to unfold and the range of remediation options open to them. This understanding, in my view, will be key to developing and managing an effective controversy response strategy. And whichever route is chosen, it is critical, again, in my view, that the response, the strategy and the response is globally consistent. From last month's webcast on transparency, it's clear that tax authorities around the world are much better informed as a result of increased information flows and actually as a result of increased communication between the tax authorities themselves. Therefore, deviations, in-country, local country deviations from globally established tax policies or practices are very likely to give rise to questions from those local tax offices, which will then need to be explained. For instance, a settlement in one country may be picked up very quickly by other countries around the world, and what may have seemed like a really acceptable small cost in one jurisdiction may, in hindsight, not be that appealing if other countries start wanting the same deal. So with that in mind, Mike, can I stay with you and ask you what are some of the controversy processes that we encounter in practice?
Well, I think the controversy process involves a lot of key decisions that taxpayers need to make as early as possible, and sometimes they have to do it simultaneously. Questions like, should we be reactive or proactive? Should we approach things unilaterally or bilaterally, multilaterally? Should we go with exam, audit, defense of the tax return position? Should we pursue an advanced pricing agreement? And the optimal path depends on a number of factors, such as, especially today, the tax structure. What are the optics of the tax structure? Is there high or low risk with respect to what tax authorities might view? High-risk business models feature, for example, a low effective tax rate, a non-alignment of functions and risks, and profits in stateless entities. Another factor is what information is available to tax authorities. What are they going to see? And, of course, more fundamentally, the capabilities or the capacity of the different tax authorities. And so taking that all into account, what is the perceived audit risk? But then, of course, something that affects that is the degree of coordination between the tax authorities. And as I said before, I know I'm like a broken record, but the issue of the potential interpretive differences between the related tax authorities on some of the existing texts, like the transfer pricing guidelines. Now, I think there's a range of approaches you can take along the reactive versus proactive and unilateral versus bilateral spectrum. At one end, kind of a domestic or unilateral approach would involve filing the tax return and then just tactically reacting to proposed adjustments by the revenue authorities. So the taxpayers challenging the adjustments, they may attempt to settle the issue through a formal appeals process or through litigation. And some targeted issues might be dealt with unilaterally through special rulings. Now, along that spectrum, if you think about taking a slightly more proactive approach, a taxpayer may identify like systematic or recurring issues in particular jurisdictions and decide that undertaking one or more unilateral APAs will ensure certainty. Taking a more comprehensive and proactive approach, a taxpayer may attempt to simultaneously resolve ongoing issues in multiple jurisdictions and achieve greater certainty through bilateral or multilateral APAs. Now, regardless of the taxpayer strategy for managing controversy, controversy itself often leads to double taxation, I guess with the exception of a successful bilateral or multilateral APA. Taxpayers typically have recourse to administrative procedures and to courts to deal with resulting double taxation. But obviously, cases of double tax are often better resolved at the international level between competent authorities of the states. So typically, a tax treaty will contain a provision stating that if taxation is not in accordance with the convention, a taxpayer can request the governments involved to enter into a mutual agreement procedure, MAP, and, quote, endeavor to eliminate double taxation. So good luck on the endeavor. They're going to try. Now, in principle, pursuing MAP shouldn't jeopardize the judicial process, but in practice, this may not be the case in some jurisdictions, so one needs to carefully weigh the alternatives. While many countries have fairly robust MAP programs, like the U.S., the U.K., the EU countries, and others, many countries are still developing their tax administration infrastructure, or in practice could discourage access to MAP. So although many countries are currently in the process of adding resources to APA and MAP, it's probably fair to say that while MAP provides important double tax relief in theory, it often falls short in practice. And I think there's always been a recognition that there's a need to improve the MAP process, which is reflected in Action 14 of the BEPS initiative. Now, prior to BEPS, you can imagine a taxpayer would assess some of the factors we talked about and pursue what for the taxpayer is an optimal path. So it balances the need for certainty and singular taxation with, the costs and burdens of achieving the outcomes. And so for some taxpayers, it might have been entirely reasonable to pursue a purely unilateral domestic approach because of ancillary factors like the availability of NOLs or foreign tax credits. They may have had a good track record using these approaches, and it may be the least costly approach. And such one-off solutions would be particularly attractive when the tax systems operate in silos. But the post-BEPS, post-EU environment clearly changed the calculus for managing controversy because, for example, the BEPS and the EU measures and their different interpretation among jurisdictions that alone will lead to a lot of controversies and higher stakes. The enhanced transparency through CBC, the country-by-country reporting, master file, local file, the automatic exchange of information enhancements are going to be kind of eliminating a lot of the silos. And so tax inspectors, they currently more routinely share information with each other through perhaps a liberal interpretation of that, quote, foreseeably relevant standard. And in addition, without any necessary obligation to even notify the taxpayers. So in addition, previously confidential tax return information, it risks public release. Like look at the proposal to publicly disclose CBC reporting in the EU. The U.S. considers this to be tax return information, for example. Another couple of points in which the post-BEPS world have kind of changed things. Joint audits, where there's actually enhanced coordination on the ground between revenue authorities. And I think also you have to add more aggressive auditing strategies, which raise the stakes and raise the need for resolution, like the nightmare you hear about tax authority raids and criminal sanctions and threats to apply alternative measures like the DPT. So the need to take a proactive or bi or multilateral approach, I think it's just greater. Now, fortunately, access to MAP has been improved. The BEPS project introduced a minimum standard on MAP, which is basically an attempt to apply best practices, and over 100 jurisdictions have committed to it. And the MLI, the multilateral instrument, facilitates implementation of these measures into the existing bilateral tax treaties. And importantly, it includes binding arbitration to ensure complete relief from double tax and over 24 countries have committed to that. And the EU has sought to accelerate and embed these best practices across all EU members with a new directive on dispute resolution. So nevertheless, the outcome is still less predictable than the outcome. The outcome of MAP procedures is less predictable than the outcome of bilateral or multilateral APAs, and so is more likely to result in a deviation from the global tax and transfer pricing policies. If there's a potential for other tax authorities to take this deviation as a given, the global consequences of this should be considered. So bilateral and multilateral APAs continue to be an option of choice. And so for illustrative purposes only, I've added a slide that sets out kind of a controversy procedure flowchart and some of the key decision or flex points for taxpayers. This is U.S.-centric, but it kind of illustrates the complexity of the process. And to the extent you find it hard to read on your iPhone, the legibility will actually be better if you download it and read it at your leisure.
Thank you, Mike, for a thorough analysis on thoughts that a company needs to consider in order to navigate the controversy process and the options available under, I think we could call that a file and defend approach. I would also be interested in your comments, however, about the strategies around MAP and APA. For instance, in determining an approach to MAP or APA negotiation, is the order in which you approach the different tax authorities of potential importance? What do you think?
Yeah, no, I think that could be really important because one would need to assess up front the experience of the various competent authorities in actually negotiating multi-country positions. So some jurisdictions have a lot of experience, and others, as well as those most critical to a successful negotiations, they should be approached first. And it makes sense to consider this point when contemplating any change to a group's business model or legal relationships in terms of what impact that might have on the resulting MAP or APA network.
Okay, thank you, Mike. Luis, you're back?
Yes.
No? Okay, great. So turning to you, what are your observations about the controversy environment in Asia Pacific?
Alex, the MAP process in Asia Pacific generally works, and similar to other locations, the major observation by most taxpayers is the length of time it takes to conclude them. It is quite positive that a number of the countries that are non-OECD members have signed up as associate members in light of the BEPS project, and hence we should be seeing very soon cases that are initiated within the 24-month resolution expectation, and in certain instances, a push toward mandatory binding arbitration. APAs generally work in most of the countries that have them in place, with minor exceptions, and more taxpayers are considering them as an option to negotiate complicated cases up front in a more amicable environment than the traditional controversy route. The joint and simultaneous audits mentioned before could actually turn out to be a route to prevent and deal with discerning points among tax authorities in a current stage, as opposed to the traditional one-sided analysis and catch-up. Perhaps it could also contribute to level the playing field between the more experienced tax administrations and the new entrants to the international tax arena.
Well, and I think, gentlemen, that I think do we need to mention that what Alex called the file and defend approach is a strategy that relies upon robust files. Companies choosing this path to carefully review their policies and documentation in the light of all new guidance and commentaries, and do not wait before BEPS documentation until it's time to defend it. Going through mock audits, testing also a global consistency is often a good strategy to determine whether files are indeed up to date. For instance, regarding intergroup services, it will be relevant to understand in detail the importance of benefit tests once a service charge is applied within related parties. It is necessary to document how the receiver of the service improves its business operations due to the service. The cost allocation method needs to bear the various versions of the transfer pricing guidance in mind. There will be difficulties to demonstrate a benefit of the service if the cost is not allocated objectively to the specific receiver. So these are points that I think are really relevant at this point.
Yeah, Catherine, I agree. And it could make sense to, for instance, proactively establish policy and practice that compares allocated charges against the revenue of the local entity. If the proposed charge exceeds a threshold amount, for example, then examine more closely. This review may help with local audits by demonstrating consideration of the impact on local finances. Of course, benefits to the local or paying entity must also be considered.
Yeah, exactly. And we haven't talked that much about transfer pricing on goods, but in Latin America, it would be very important to document properly the actual goods transaction, not only referring to the transfer pricing report describing functions, risks, and assets involved in intercompany transaction or related parties, but embedding this in formal distribution agreements that include the condition of the transaction between parties, including pricing terms, marketing expenses, allocations, responsibilities, currency risk, product risk, among others, and to map this information and documentation with objective and quantifiable information. I would like to make a brief comment about MAP and APA processes. In Latin America, APAs have been included in the transfer pricing regulation in the major economies in the region. As you may know, there are APAs procedures in Mexico, Colombia, Chile, and Peru, but only Mexico has developed a more prolific program. I believe it gets stronger and more attractive to clients with BEPS. On the other hand, the other three countries have little to no experience with APA procedures. There will be more pressure for other tax authorities in the future to get this process moving forward. Now, regarding Brazil. Brazil has included MAP recently into the tax legislation. The Brazilian tax authority has expressed its willingness and openness to start MAPs. We at EY Brazil have been closely discussing with the Receita Federal how we can help them to get this process implemented as soon as possible. And I think this MAP is a good news when we talk about BEPS impacts on Brazil. MAP is bringing a light at the end of the tunnel regarding the lack of consistency between arm's length principle and the Brazilian transfer pricing methodology.
Thank you, Catherine. Luis, up to this point, we have concentrated on how companies can manage the controversy process on audit, and in particular the range of strategies, both reactive and proactive, open to companies for defending or resolving matters under contention. However, there are situations that companies may want to undertake a more fundamental review of their structure and operations, and that's particularly if there are elements of their operating model that could or would be inconsistent in a post-BEPS environment. And Matt, you've had some experience with, or some wide experience with groups who have responded by changing their structure rather than the file and defend, and I'd hope you'd like to expand on that a little bit.
Thanks, Alex. I'll do that. Just before we go there, I would like to mention a development with policy objectives that is something similar to a multilateral APA, and that's the new OECD International Compliance Assurance Program, or ICAP. So that's a voluntary program that will use CBC reports and other information to facilitate open and cooperative multilateral engagements between multinational groups and tax administrations, with a view to providing early tax certainty and assurance. In our last webcast, we discussed the pilot program that's due to be launched, which will involve up to 8 jurisdictions, the bigger countries. In the simplest terms, a group of countries will work with the taxpayer to review its CBC reports, and if all is well, the company will receive assurance that they will not get further compliance interventions for a period of time, at least not driven by their CBCR reports, assuming such reports don't change materially. Any issues that do require attention will be handled outside of the ICAP program via standard processes like APAs or, if necessary, a tax audit. So I think that while any kind of multilateral approach to providing more tax certainty is a great objective, we should be careful not to overestimate the potential of ICAP. A couple of reasons for that. First and foremost, ICAP only looks at a fairly narrow scope for taxpayers' total tax picture. That's really the CBC reports and transfer pricing. It doesn't look at the whole of the issues or the whole of the tax strategy. Secondly, it's only a pilot, so only a small number of taxpayers, a very tiny percentage of total taxpayers, are likely to be able to access it. Thirdly, and perhaps most challenging of all, the program, at least as it's currently conceived, is only open to low-risk taxpayers. And as such, there's a sense that the program is struggling to attract volunteers. And indeed, it really makes much more sense to me for the ICAP to target higher risk taxpayers who are seeking to move down the risk spectrum to be lower tax post-BEPS. We'll have to see how the program evolves as it moves from pilot to more general release. Going back to your question, Alex, as we've seen earlier, the changes introduced by the BEPS initiative, together with EU and national measures such as DPT, have been so fundamental and wide-ranging that every multinational group should undertake a review of their structure and operating model to make sure that going forward their structure is future-proof. Again, there's a wide spectrum of potential options for restructuring. At one end, relatively minor modifications may be enough to iron out, for example, inconsistencies in transfer pricing arrangements between countries undertaking similar functions, or restructure holding companies affected by the principal purpose test that will be introduced by the MLI. Maybe a bit less minor, we're seeing numerous European headquartered companies converting commissionaires in market to distributors in market to address risk. And then at the other end of the spectrum, quite fundamental changes might be required to reorganize business models where the ownership of IP or current profit allocation is not aligned with the location of DEMPI activities, or where there are other features that would raise interest from tax authorities under BEPS-type reasoning, or for that matter in the EU from the European Commission state aid perspective. With these types of business models, the risk inherent in existing structures increases with time and inactivity. Apart from deciding what type of remedial restructuring may need to be implemented, there's also a risk that the transition from one business model to another will in itself generate controversy if tax authorities are minded to argue the case retrospectively. This may lead, potentially, to long, slow, expensive, and destructive disputes in multiple markets with uncertain outcomes. It's an area fraught with difficulty for companies seeking an element of certainty, both regarding their past and future business models. In addition, we need to be aware that certain key countries have created an informal grouping beyond JITSIC, the so-called E6 countries, exchanging information between themselves, including on negotiation and settlement experience related to certain high-risk business models. Therefore, an important component of the restructuring exercise will be how to present it to tax authorities and come to an agreement on the tax consequences of the transition. One further element being whether this should be done on a country-by-country basis or on a multi-territory basis. So to bring that to life, I thought it would be helpful to the audience to outline a couple of case studies to illustrate the types of issues and remediation strategies we're encountering, particularly in the UK, where these types of discussions are being crystallized by DPT cases. So one focus area is the impact of intermediary countries. Mike mentioned it. So imagine a complex worldwide group, all connected companies, with 5 functionally rich countries trading with 100 countries worldwide, everybody trading with each other. And let's say that all of that intergroup trade is via a master contracting intermediary, and that intermediary has limited functions, and the trade is indirect rather than direct. So pre-BEPS, most controversy was independent, country-specific. Most resolution was unilateral. The intermediary provided commercial simplification, a single contracting entity, and no tax disadvantages. Post-BEPS, with much more emphasis on bilateral APAs and MAP to prevent or resolve disputes, the existence of that intermediary country might complicate, slow down, or even fully prevent bilateral processes being effective. As such, it may make sense to restructure to remove intermediaries and more closely align the functional footprint of the group with its legal contracting model. That can represent a very substantial commercial change and create a great deal of complexity. A different example would be profit centers where the technical analysis supporting profit attribution has been skewed towards a legal or contractual allocation of risk, and where most of the existing transfer pricing design is based on one-sided single territory analyses. Here I feel this kind of case, it's urgent and critical to build a multi-country, multi-sided defense file that supports the return in the profit center by reference to something more than legal or contractual allocation of risk. Absent that minimum step, in some cases taxpayers will find they're exposed to extended statute of limitations or penalties in the event of a source country audit. On a prospective basis, that defense of that profit center would of course be reinforced with a business model restructuring, such as onshoring the IP, but the retrospective position is what causes the most difficult controversy and maybe requires the most urgent additional support.
Yeah, Matt, I can attest that we have similar situations in Asia Pacific, whereby, for example, Singapore is sometimes caught in the middle.
Thanks, Matt. Louis, before moving to our closing section, I'd like to ask a final polling question to the audience regarding their overall confidence in achieving a higher level of tax certainty in the next 12 months. And as you are answering the polling question, I'd like to ask our panel to briefly cover some of the less anticipated consequences that can arise in this new environment we find ourselves in. And I'd like to reiterate the lowered PE thresholds that Matt already mentioned to trap the unwary business traveler and have his or her remuneration caught in the tax net of the country of travel under Article 15.2c of the OECD Model Treaty. And I think that HR departments and corporate teams need to collaborate carefully and review where potential new PEs arise and where the remuneration of a traveler could be deemed to be borne by that PE under source country determination. And again, as Matt already did, we have a webcast on November 9 on that if you want to hear more about that. Catherine, any unexpected consequence on your mind?
Sure. Well, tax authorities are more connected and share more information that will allow them to get a complete picture of the tax framework of a transaction, not only direct tax, but also indirect taxes. As we have mentioned it before, there are certain intercompany transactions on tangible goods that have impacts on VAT and customs. So the recognition of a royalty, for instance, a royalty payment of an imported good will need to be considered in the custom value of the good. So this custom value adjustment will affect the duties base and VAT. Another example will be in a case of a transfer pricing assessment of imported goods for reselling in the local market. If the tax authorities consider a higher margin for the audited distributor and make assessment on that regard, custom value needs to be adjusted as well. And in many cases, a penalty might apply due to incorrect custom value declared at the border. In other words, any type of transfer pricing adjustment needs to be very carefully considered from an indirect tax point of view.
Indeed, Catherine, and not just from an indirect tax point of view. Many countries will consider the ripple effect of adjustments to transfer prices on profit distribution. Imagine if a tax authority makes the point that the transfer price into the country was too high and subsequently lowers that price, that increases the profit in that country. Now, that increase in profit should also have been positively affected its retained earnings. If its retained earnings didn't in fact increase, then a dividend distribution should perhaps be deemed to have taken place and dividend withholding tax should have been paid. All of this, again, with potential penalties and interest, including limitations on accessing foreign exchange for remittances.
Thanks for that, Louis. Mike, any thoughts from your side?
Well, I've already mentioned tax raids and criminal sanctions in this webcast, which I have to imagine are quite unexpected if they happen to you over a tax controversy. But in addition to these type of direct and confrontational elements, past and potential future controversies may just lead to skittishness of multinationals' direct investment decisions or acquisition behavior. For example, it may be unsettling to companies who've reached agreement with tax authorities in EU jurisdictions to have these agreements upended by a supranational authority with which there's no treaty relationship. Such an uncertain landscape also affects the value of companies and makes otherwise economically sound acquisition decisions less viable. The potentially open-ended tax positions may be a significant stumbling block. One more thing, the interaction of enhanced tax uncertainty with other aspects of international tax policy, such as the potentially significant lowering of the U.S. corporate tax rate, could result in greater onshoring of valuable IP to the detriment of offshore jurisdictions and supranational authorities.
Thanks, Mike. Matt, any further unexpected consequences?
Yeah, so we heard quite a lot on this call about retrospective liability, and I definitely encourage people to think about the financial statement impact of controversy in this regard. This is the really insidious aspect of a dynamic interpretation of BEPS 8 to 10 combined with transformed administrative approaches. Those things together mean we see retrospective tax liabilities even when there's been no change of law and no change of facts. And those obviously can be very disturbing. So I think fully up-to-date approaches to financial statements provisions are incredibly valuable to companies. They allow much better communication with analysts, they anticipate brand and wider public relations concerns, and they manage the communication flow between the tax function and the board. The provision position also has an enormous impact on your ability to manage the controversy, on the internal perception of the controversy, and therefore the options that can be used to address it. In simple terms, settlement is way easier when I'm provided than when I'm not provided. If I'm not provided, I get driven towards more confrontational management strategies. We all know that transfer pricing is not a scientific discipline. The changing paradigm with which tax authorities look at these matters has to be continuously reviewed. A very simple example is that TP-related adjustments did not historically lead to penalties in the UK and other countries where the underpinning analysis was supported by a high-quality benchmarking report, for example. Numerous tax authorities are now starting to say that one-sided approach to functional analysis might be careless, leading to potential penalties even if there's high-quality benchmarking.
Thank you for that. So great. And as we close, because we're quickly running into that time, I would like to thank today's excellent panel, Catherine, Mike, Louise, and Matt, and I'd like to give them one last opportunity for a final thought or perhaps a key message for our audience. Mike, can I start with you?
Yeah, sure. The information avalanche that's heading in the way of tax authorities around the world, in combination with much closer ties between the tax authorities as a result of, for example, information exchange agreements and joint audits, and actually the BEPS project process itself, will result in significant increase in questions. Corporate taxpayers need to be aware of this because it will depend on their abilities to deal with these questions, whether these questions turn into controversy with the tax authorities from many of the BEPS framework jurisdictions.
Catherine?
Yes, Alex. I think that many tax authorities are getting prepared for this change by further investing in common tools such as studying and understanding the BEPS reports and creating and deploying practices like the CBCR handbook. But also, as we see in Brazil and Russia and Australia, by upgrading their information technology and simply ramping up their resources. I think company needs to think about their internal controversy management organization, make sure that they have centralized transparency over the processes, and as I mentioned before, be ready with robust documentation.
Matt?
I think the proportion of controversy which is settled by local matters is declining. So disagreement with local authorities could be dealt with through local settlements or through the local judicial system, shifting towards multi-country controversy. Much as the transition from single-country transfer pricing to multi-sided transfer pricing, single-country controversy resolutions have moved from being the overwhelmingly most common approach to now being more likely, because of the coordination and information sharing between tax authorities, to be multi-country. So I'd advise companies, as a matter of practical policy, to consider the impact of each local settlement on their global controversy position.
Thank you. Finally, Luis.
I think what all my fellow panel members are saying, and perhaps this has been the red line throughout our entire discussion today, is that global consistency will be key. Whether corporations have prepared or filed detailed or high-level Action 13 documentation, their supply chains and finance organizations are likely to be studied and remapped not by a single tax authority, but by interested teams of tax authorities that will share and discuss this information. In my view, a globally balanced and consistent approach will be key in managing controversy the next few years.
Luis, thank you for that. As you have heard and will see on the screen, we have some excellent resources in EY that can help you both stay up to date with controversy developments and also help you form your response. I would like to thank you, our audience, very much for joining us today. And before you sign off, please take a moment to open the red feedback icon and let us know what you thought of today's program. And if you have been with us for at least 80 minutes and you've responded to the polling questions and completed the feedback form, you can now download your education certificate by clicking on the purple CPE icon at the bottom of this interface. I'm Alex Posma, and we've been bringing you news and insights from EY on the current corporate tax controversy landscape. Thank you for listening.
This concludes today's conference call. You may now disconnect. Presenters, please remain on the line.